Week 3 of 2026, Act 3, Greenland. Renewed tariff threats from the US if they can't buy Greenland add to the ongoing security concerns for Europeans. Europe may have absorbed last year's trade shocks calmly, but security questions to this extent may trigger somehow a different reaction, especially when not all countries are affected equally. So is this the last drop in Europe's patience? I guess we will find out quite shortly. With world leaders gathering in Davos this week in Switzerland, the timing could hardly be better. And whether markets continue to shrug or react to the new news will depend on how far this latest act is allowed to go. Initial market reaction is US and European futures are down, while gold hits a fresh record high. So welcome to Swissquote's Daily Market Talk. We are Monday, January 19th. I'm İpek Özkardeşkaya, and everything I will say in this video is based on my own opinions and analysis, even more so as topics become extremely sensitive, and this is not financial advice.
This show is brought to you by Swissquote.
Something quite unusual happens to me since a few weeks now. I lose my words. I lose my words in the face of the absurdity of the news flow these days. I simply don't know what to say and how to express myself staying polite. And every week since this year began 3 weeks ago, well, kicks off with abnormal news. The first Monday of the year, it was the US creeping into Venezuela to take its president out of his bed and take him to the US. Oil prices initially jumped, but the rest of the market barely flinched. Last week, remember, was the second Monday of the new year, and Jerome Powell took the hit with an investigation into Fed's headquarter renovations, which he brilliantly pushed back very early on, saying that this investigation is not conducted against him or the renovation of the Federal Reserve's headquarters, but it was the expression of the White House's frustration with the Federal Reserve's policy of cautious rate cutting. That certainly tempered any reaction from the market, and a very sharp reaction, but added to the level of unease regarding the Fed's independency and the consequences. So gold and metal prices hit record after record last week. And this week starts with the news that some European countries will be slapped with fresh US tariffs, 10% starting from February 1st and up to 25% from June onwards until the US acquires Greenland. Needless to say that gold kicked off the week by a refreshing record. It hit $46.90 per ounce level in Asia. Silver also traded at a fresh record high, a touch above the $94 per ounce mark. Copper is also up, because the US dollar is down on reviving trade tensions between Europe and the US, and the European futures are unsurprisingly in the negative and preparing to start this new week on a bearish mood. In the US, it's bank holiday. So my personal feeling looking at the news flow is that the foundations of potentially significant market sell-off globally could be thrown right now. Whether it will be due to geopolitical frictions or renewed trade tensions, I don't know. But it would be odd to see investors not react at all to what's coming, at least for some while. So that could somehow overtake the earnings season and the news. So this week, the world leaders will meet in Davos in Switzerland, and the timing is obviously perfect. The potential implication of Greenland will be felt intensely, of course. Europe may have managed the tariff crisis of last year with a lot of calm, but the security threat is something different and may see a different kind of reaction. First, only a handful of the European countries are facing tariffs, not all of them. That's very vicious. I'm not a geopolitical expert, but divide and conquer is seemingly at play and could complicate the inter-European relations if the Europeans are not smart enough, as decisions won't have the same impact on everyone and could further weaken the continent. I hope the Europeans will be thinking twice before reacting to the latest news. The most realistic option, however, is Europeans slapping back with the so-called anti-coercion instrument, which is a legal framework that allows the European Union to push back collectively when a third country uses economic pressure to influence EU or member state policies. Concretely, it could result in retaliatory tariffs against the US, especially the US big technology companies, for example, but also some investment restrictions. That's certainly why the technology-heavy Nasdaq futures are under a heavier downside pressure this morning than the Dow Jones futures. So what's clear in this unclarity is that Davos will be very interesting this week and that the European defense stocks have probably plenty more to enjoy the darkening global geopolitical skies. Elsewhere, the Chinese stocks start the week feeling the pinch of mixed economic data from China. Here we have better than expected production and growth figures, but softer than expected sales data that continue to scream that China needs others to keep going and keep growing. Happily for the Chinese, though, the winds could be finally turning direction. On Friday last week, Canada's Mark Carney met Chinese President Xi Jinping to sign a trade agreement. And pictures were unreal. Carney and Xi Jinping smiling and shaking hands as if they were friends for a long time. But no, it's been about 8 years since the two countries didn't get this close, diplomatically speaking. So my guess is that there is growing chance that we see a similar U-turn in Europe's facing China as well. After all, the common values with the US are no more. So if you want good news this Monday, you should go all the way to South Korea, where the geopolitical headlines have no strength compared with the appetite for buying technology stocks there. The Kospi Index, careless, is up to a fresh record high. Their domestic tech champions like SK Hynix and Samsung are leading the gains. But nearby, just nearby, the Japanese equities are also less comfortable with the global geopolitical headlines of this morning. First, the global headlines and the rising trade tensions between the US and Europe just are not soothing for the Japanese. They're friends with everyone, so who to choose in this conflict? Then the Japanese yen is struggling, or say, Japanese yen bulls are struggling to beat the base these days, even though the dollar yen at the current levels makes Japanese politicians extremely frustrated and much keen to intervene directly in the FX markets to relieve the selling pressure and clear the short positions that are running hot these days, at least for a while. But alas, the bears keep charging. So what's next? I guess the 160 level will likely be the sand in the line, the barrier that will trigger FX intervention from officials. But on the other hand, the Takaichi trade is running very, very hot too. Remember, this is a trade that supports Japanese equities and weakens JGBs and the Japanese yen. And the selling pressure on the yen has been heavier since Takaichi called a snap election earlier this month, last week precisely, to consolidate her power and hope to squeeze more fiscal support out of her hat. The Bank of Japan, on the other hand, is willing to hike the interest rates to tame inflation in Japan that rose to the levels that my generation of Japanese haven't seen in their adult lives. But alas, even that is not helping to ooze the Japanese yen bears out of the market. Even the broadly sold US dollar this morning doesn't help the dollar yen fall and stay there. The dollar yen dipped to 157.50 this morning before rebounding in Tokyo. So what could reverse this yen selling? Well, interestingly, there are rumors that Takaichi may not get lucky in the upcoming snap elections that she's calling for. According to these rumors, Japan's largest opposition party and a former ruling coalition partner are forming a bloc called the Centrist Reform Alliance to ooze Takaichi, to focus on improving the lives of ordinary people in Japan, which goes through stopping the yen's depreciation and countering inflation, and taming fiscal support could do a bit of that trick. So latest reports suggest that the snap election could be scheduled for February 8th, but before that, the Bank of Japan is meeting this week, but is not expected to announce a change to its rate policy just yet. However, the next Bank of Japan hike could arrive as soon as April is said if the Japanese yen weakness continues and inflation persists. For traders, the actual levels in dollar yen look appetizing for top sellers, but that also means swimming against a strong trend here. So my best tip here is try not to be too greedy if you're on the long the Japanese yen side of this trade. So this is all for this Monday of a week that is clearly going to be an interesting and probably a long one. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, Good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.